Well, the year 2018 has been a bit of a challenging year for the Chinese economy and financial markets in China. The trade conflict has been escalating between China and the US. It has been omnipresent. It has been weighing on sentiment and has taken its toll already on the economy and on the stock market. Well, on the positive side, authorities have responded to that. They have taken several measures. For instance, they have announced tax reliefs in order to support the economy, in order to calm markets. And we think this is a positive sign, and we think this is going to support the economy and markets going forward. Well, beyond the trade conflict, there's another big topic for the Chinese economy, namely the question how to transform the economy from being less trade dependent and being more focused on domestic growth, especially on private consumption. This is the big aim and target of the Chinese authorities. We've seen some progress there, but there's still some room to cover going forward. For instance, if you look at the consumption to GDP ratio, this ratio stands at around 60% or even higher in some Western industrialized economies. In China, it's only at 40%, so a lot of room to cover still and a lot of potential. Well, from a financial market perspective, the consumption theme in China is really interesting because it offers a lot of long-term growth prospects and a lot of growth potential. And with our China consumer basket, we have identified companies that we think are in a really good position to benefit from these long-term trends. For instance, in the healthcare sector, in luxury goods sector, or in the sector of e-commerce. And we think this is a really good long-term potential there. And on top of it, also in the short term, we think there's a good chance that consumption-oriented companies will be a bit more resilient in case the trade conflict is going to escalate further.